Hey everyone, hope you're all doing well. If you're new to the channel, please consider subscribing. I'm going to keep dropping tutorials and stock reviews, and you want to be sure you don't miss out on any of that great content. So we're now on video 3 of the How to Value Stock series. We're going to be taking a deep dive into the income statement. So we're on Yahoo Finance. If you're unfamiliar with the site or don't know what I'm talking about, I kind of talked about it briefly at the end of last video if you want to go check that out. But I'll walk you through it anyways here today, so don't worry about it. But yeah, let's get started, and we're just going to head over to financials since we're going to be looking at the income statement. And we have our 3 financial statements, and it'll take us straight to the income statement. So the first thing to note here for all 3 financial statements, you always want to kind of be aware of the order of the accounts because it's the same for everyone. And we start with revenue, right? Move to expenses, and then always end with our bottom line or net income. And we're going to be using Amazon as our example company today, but kind of looks the same for every company. You'll see some slight differences, but if you understand the concepts and definitions in this video, you'll be good to go for any company you're ready to analyze. So let's start at the top, and I'll explain each account as we go. I think that's kind of the best way of tackling it because you see all these numbers and it can probably be overwhelming. So I'm going to go one by one, and I know you guys will get it. So revenue, right at the top here, is the total amount of sales a company has. So for Amazon, this is just the total amount from all their sales in the last 12 months. And let me kind of explain it at the top here since we're breaking everything down. So TTM stands for trailing 12 months. So this is their revenue in the last 12 months or the last year. 12/31/19, this would be their revenue from all of 2019, their revenue from all of 2018, 2017, and so on. So yeah, really the only one that kind of might be foreign to you here is TTM, but that just stands for trailing 12 months. So you can think about it as the revenue in the last year. So finishing revenue, we want to see revenue going up, right? More sales means more money for the company, which means the value of the company increases and the stock price goes up with it. And that helps us as investors, right? So yeah, revenue is just total sales. Don't overcomplicate it. Pretty simple here. And then now we're going to talk about cost of revenue, which is our next account here. And this is sometimes referred to as cost of goods sold or COGS or COGS. They all mean the same thing. And these are the direct costs related to making the product or providing the service. So since we're looking at Amazon, let me give you the easiest example I can think of, which would be, let's say we're looking at their Amazon Basics products. And these are just the products that Amazon actually manufactures themselves and sells on their site. So what goes into making, let's say, their Amazon Alexa, right? So they sell it for X amount, not sure how much it goes for, but we'll call it $50. So that would add $50 to revenue. Now, what are the direct costs related to making that Alexa? So the components to make it, right? That would be part of our cost of goods sold. And then also the salaries of the people actually assembling it. It's probably done by robots, but we'll keep it simple and just say that the people who are making and actually assembling it, their wages would be included in this cost of revenue or cost of goods sold. So this is just all the direct costs related to the product or service that Amazon is selling, or any company you're looking at is selling. So just think of it as the direct costs, what directly goes into making this product or service, and that's cost of revenue. And then that brings us to gross profit. So gross profit is just our total revenue minus our cost of goods sold. So this tells you how profitable the company is after taking out direct expenses. And it's also shown as a percentage sometimes, as a percentage of revenue, to show what percentage a company is left with in profit after just accounting for direct costs. So, right, so our revenue, right, that $50, let's say that the Alexa sells for $50, just continue with that. And let's say the direct costs that go into making it, right, the average salary that goes into making it, the people actually on the assembly line, their wages, let's say $10 for one Alexa, probably overblown, but whatever. And then let's say the components cost $20. So our 50 revenue minus our 10 in wages minus our 20 in components would leave us with 20 gross profit. And then you just do that for all the items, and that's how you end up ultimately with your total gross profit here. So let me just keep it simple. What to take away: gross profit is total revenue minus direct costs, and that's your gross profit. So that brings us to our operating expenses. And this includes, if we open it up here, our general and administrative expenses and also research and development expenses. And these are the company's indirect costs. So our cost of revenues are direct costs, what directly goes into making that product. And now operating expenses include our indirect costs. So general administrative costs, these include marketing and advertising costs and salaries paid to executives. Excuse me. So, right, this would be, let's say the COO or chief operating officer. He has a nice hefty salary at Amazon. He doesn't directly make the Echo that we're talking about or the Alexa. So his salary wouldn't be included in the cost of revenue since he's not the one directly making the products. His salary is more of an indirect cost and would be included in the selling general and administrative cost. So indirect. And then research and development or R&D expenses are incurred in the process of finding and creating new products, improving current products, or working on intellectual property, right? These are just all their research costs that they're doing to come out with new innovative products and services for their customers. And yeah, so operating expenses, main takeaway, these are our indirect expenses, right? Not less important, don't think about it that way, just not expenses that directly go into the product. And then other is just, yeah, what it says, other expenses that are indirect in the making of the product or service. So that's going to bring us down to our operating income. So we get operating income by subtracting our operating expenses from our gross profit. So 81 minus 65 gives us that 16. And this is how profitable the company is after taking into account all internal costs, but before taking into account any external costs. And our external cost is what we're going to talk about in a little bit, but that would be our taxes and other income and expenses. But let's not worry about that for now. We'll get to that in a minute. So this is really important because it shows if a company was profitable after considering all of its core business activities. And if this is negative, but net income is positive, that's usually not a good sign. That means that the company most likely was able to make their net income positive from something that's a non-core business activity, something that's like a one-time sale or something that's just not going to recur in the future or happen again in the future. So you want to make sure that operating income is positive in most cases. The two will be some, like if operating income is positive, then net income will be positive. And if operating income is negative, net income will probably be negative as well. But just something to note there. And right, this is really important because this is really what we're left with from our core business activities and our core business costs. So this is really a good indicator of the true profit of the company after considering everything that's important and something that happens in normal business operations and conditions. And then what's not normal business operations and conditions is our other income and other expenses. And this includes all non-recurring transactions from activities that are not undertaken in the ordinary course of the company's business. So net non-operating interest incurred and received, this one right here, this would be interest received or paid from outstanding loans, right? And Amazon in this case is not a bank. It's not in the business of collecting interest. So that it's something that's not part of their core business. So that's why it's in the other income. And then if we open up other income and expenses, we can see a gain on sale of a security. They had one in 2019, right? Amazon is not a brokerage. They're not in the business of buying and selling securities. So this is something that's not normally going to happen. And we can see it widely fluctuates, right? It's just kind of random. 346 here, negative 183 here. Like it's all over the place. So these are the non-normal income and expenses, and they're important because obviously it's affecting the cash of the company. But something that you're not going to use. If you're thinking about next year's revenue, you don't really want to think about stuff that's not part of their core business. So, but nonetheless, we are going to take those out to get to our pre-tax income, which is just our operating income, plus or minus these other income and expenses. And this is just our profit or income. You'll kind of hear me refer to them interchangeably. Profit, income, earnings, they all kind of mean the same thing. This is just the profit of the company. There's just finance has to make it confusing and give it a lot of ways of saying it. And you'll hear that a lot, but don't worry about it if you get confused. Just always use Google. Google's your friend. Investopedia is your friend. So just make sure to leverage those resources and hang on, because it's not hard stuff, just a lot to consider and take in. So don't worry and just use your resources. But nonetheless, pre-tax income, yeah, that's just our profit before any taxes, and then tax provision is just our how much the company has to pay in taxes, and we take those two out, and that brings us down to our net income. So so it looks like they had 16. What would this be? This is millions, but the numbers are in thousands. So I want to say it's 16 billion. Don't hate me if my math is wrong, but I want to say it's 16 billion less 3 billion in taxes, and that brings you to the net income. And the net income is just our bottom line. This is our pre-tax income less our taxes, and this is just what's left after considering all the expenses, the direct costs, the indirect costs, taxes, other income and expenses. This is everything all taken in, and this is what's left over. And this isn't necessarily the cash that the company has, which is why it's a little deceptive, but something that's really important, and you got to know that net income is just, okay, once we take everything into account, what does the company have left over according to the accountants? And that's our net income. So now if we scroll down, this is the main part of the income statement. Like if you are like, okay, I get everything up to here, you're good to go. Good job. But there's more, of course. And to keep it simple, we can see some other metrics listed down here. EPS, that's our earnings per share. So that's just our net income divided by the number of shares that the company has. That'll bring you to the EPS. Let's see what else is important here. I would say really the only other thing that you want to know here is Ebitda. And Ebitda stands for earnings before interest, taxes, depreciation, and amortization. So to calculate Ebitda, we would take our operating income, right? Our operating income is right here, and it's before, right in the name Ebitda, before our taxes, and then our interest, which is our other income. So yeah, it's just our operating income because it comes before those external costs. And then depreciation and amortization, if you aren't familiar with those terms, don't worry, I'll give a quick explanation of those. But it's just an accounting method. Depreciation is just an accounting method of allocating the cost of a tangible asset over its useful life. So let me break that down. I think an example is the best way to explain it. So if you buy a piece of machinery for $20 million and you think that you're going to be able to use that machinery, let's say a car. Let's just keep it really simple here. Let's say you buy a brand new Tesla for what are they going for now? $40,000, okay? You think you'll use that Tesla for the next 10 years. So if we do something called straight line depreciation, we just take that 40,000 and divide it by 10. That gives us 4,000. And that's what we're going to say the decline in value is per year for our Tesla. Now that's not true, and that's the problem with depreciation. But that's a way that a lot of companies calculate it, and that's just how it is. That's their best guess. But obviously, we know as soon as you take a car off the lot, its value probably drops more than 4,000. But we'll roll with it here, and so our depreciation expense would be 4,000 per year. So after 10 years, right? After taking out all that depreciation, then the car would essentially be worth zero, which may or may not be true, but that's just how depreciation works. It's a way of saying, okay, it's not going to be worth, right? If we just left the car as $40,000 in 10 years and said, well, it's still worth $40,000, we probably know that's not true. So depreciation helps us take into account the loss in value due to time. And amortization, which is the other part of it, is the same thing except for intangible assets like patents or trademarks. So if we think about a patent, let's say you have a patent on a new technology, a new fresh technology, um, but then 20 years down the road, maybe that technology is obsolete or not as relevant. So we want to show the decline in the value of that patent or intangible assets. And all that just to say EBITDA is just our earnings before income, taxes, depreciation, and amortization. So how do we get to that, right? Like I said, our operating income, and then we just would add back our depreciation and amortization. And you could find those expenses in the 10K if you really wanted to, but Yahoo Finance calculates it for you here, so why not take what's given? Use your resources. And yeah, that's pretty much it. I think if you know all the accounts that I talked about on the income statement today, you're in really good shape. And you may not, your head may be spinning, but if you need to rewatch the video a few times or do some Investopedia research, whatever you got to do, I really want you to understand it. And because it's going to be really important for your ability to value companies. So as a quick recap, let me highlight the most important accounts we talked about. So we have our revenue, operating income, net income, and then EBITDA. If you know those four, if you're like, if there's only four things I can take away from this video, those four are probably the most important. So revenue, our total sales, nothing more than that. How much we sell times the selling price, that's it. Operating income is just what we're left over after all of our core business revenues minus our core business expenses. Net income is just the bottom line altogether. Revenues minus all our expenses, what are we left with? And then EBITDA kind of shows us how much cash we're bringing in, right? Because depreciation and amortization, those aren't cash expenses, right? We say our Tesla is decreasing in value by $4,000 a year, but we're not giving away $4,000 a year, right? We're not losing $4,000 a year, so our cash isn't changing. The company's cash isn't changing. So that kind of gives us a better indication of how much cash we're bringing in per year, right? So profit, how much of that profit is cash that the company's generating. And yeah, so I think we're good on Yahoo Finance. I'm gonna switch over and give you guys a quick kind of review slide if you want to screenshot it, and it'll kind of give you definitions and calculations and help you out there. So give me a second and I'll take us over to that. Okay, so now we're over at our summary. Just to help you guys retain the information, just got to keep repeating it. You'll get it. Just repeat it, understand it, look at your own. I strongly encourage that you look at another company that you're interested in and kind of go through their income statement and be like, oh yeah, that makes sense. I saw that before. And it'll all start making sense for you. But here's a quick summary slide if you want to screenshot it or write it down to help you retain it. This is just kind of some definitions, some calculations, how you get there. Pretty much everything we talked about today in just one slide, because I know I talked a lot. So if you want to use this and just reference this and try and understand it that way, I hope it helps out. And that's all for this time, guys. Thanks for watching. If you enjoyed the video, please drop a like on it. It'll really help out the channel and help me out. And I'll see you next time. Thanks.